Up, Bitcoin miners, welcome to another episode of the Build a Mine podcast. I'm your host, Trevor Bello, and today we will be diving into power markets and their relevance to Bitcoin mining. So if you're new to Bitcoin mining, or even if you've been around in the space for a while, this is an episode that you're definitely going to want to understand because, as we all know, power is the one thing we need indefinitely to make our Bitcoin mining operations run. So today my guest is Jonathan Burnston. Jonathan is the managing partner at Karbone Inc, emphasizing, so they have expertise in renewable energy and power markets. So as the managing partner at Karbone, an award-winning renewable energy and energy transition trading and research platform with a strategic focus on renewable energy and environmental commodities, Jonathan oversees the Karbone commodity desks and research group and has been instrumental in launching Karbone's power, capacity, and renewable fuels desks. His expertise spans both transactional work and market analysis, often integrating with project financing initiatives. Prior to joining Karbone, Jonathan co-founded a project origination firm in the Chinese renewable energy and carbon market. Jonathan's deep understanding of energy markets and complex commodity transactions provides valuable insights that could readily apply to evolving needs of the Bitcoin mining industry, especially as it explores flexible load incentives and decarbonization initiatives. So it's safe to say that today we've got a packed episode for you guys. I hope you guys stay tuned and enjoy this episode. If you do like it, please like, comment, and subscribe, and let me know how we're doing. Real quick, before we get into the episode, I want to tell you about our Mastermind Club.
Join the Mastermind Club, a weekly gathering of Bitcoin miners sharing insights to help you optimize or build your mining business. Our community fosters open discussion and collaboration, connecting you with experts who can help you overcome challenges and find solutions faster. Every other week, we host the Mastermind Deep Dive, where industry leaders delve into the financial, operational, and optimization hurdles faced by miners like you. Brought to you by Bitcoin Mining World.
All right, guys, you can go to bitcoinminingworld.com to find out more about our Mastermind Club. So, Jonathan, welcome to the Build a Mine podcast.
Thank you very much, Trevor. Good to be here.
Happy to have you here, man. So today's going to be a real fun episode. We're going to dive into power markets, and you're an expert in power markets and how they relate to Bitcoin mining. So real quick, you know, we like to get backgrounds on the show. We like to understand kind of where our guests are coming from. So if you just want to give us a bit of your background in energy markets and what led you to focus on renewable energy, environmental commodities, and then kind of how you transitioned into the Bitcoin sector, if that all flows well.
Sure. We'll make it flow. I'm an energy guy, to be clear. And I can't claim to be an expert per se in Bitcoin and crypto. I know more than enough to be dangerous, but first and foremost, I'm an energy guy. I've spent the better part of 20 years in one form or another, one region or another's renewable energy markets. I cut my teeth in international markets for renewable energy and carbon offset credits, specifically in Beijing. I came back to the States. I went to grad school, and ever since, I've been at Karbone, as you noted, which is an industry-leading platform for renewable energy, energy transition, commodities, and data services. I came to my sector, to energy, organically, as I guess I would usually say, sort of by luck, by circumstances, by the fact that as I was, entering the job market and doing so in China, right? The issues that have led to what has now become an explosion an absolute proliferation of incentives for renewable energy and decarbonization were just really starting to emerge. So, by now this is second nature to me. This is my first language. As it connects to Bitcoin, and I can tell you more about my background per se. I can tell you more about what Karbone does. There's certain focal points of our shop and our platform which are, directly relevant to an energy intensive sector like Bitcoin mining. The fact is, not to get too far into the philosophical, I know you like to dabble in that stuff, and I'm sure we'll get to it eventually. When you look at Bitcoin, fundamentally, it is an embodiment of energy and scarcity, right? In a lot of ways, you can look at Bitcoin as a derivative of energy. And so, my world and this world have come to intersect, right? And what's interesting and what I think can be lucrative about the world that I come from is there are so many different angles. There are so many different pockets of value and ways to manage your business, taking advantage of energy market incentives, which I don't think are yet, second nature. They're not yet intuitive to the Bitcoin mining community. That's what I've found so far. We have friends in common. Scott and I have some very close friends in common who are, Bitcoin mining entrepreneurs. I've invested both in coin and as well as in, physical assets over the years. But like I said, it's to me, energy is my world. And I think there, especially, at this point in, crypto worlds, sort of this moment in history, I think there's an immense amount of value yet to be unlocked from the energy side of the equation.
Oh, definitely. All of us who are Bitcoin miners or even just kind of dipping into the Bitcoin mining sector, we need power. We need electricity. And there's not really an understanding of where that power comes from, how that power is generated. There's a lot of FUD, in the daily news, daily activities of the market where people think, oh, Bitcoin mining is not sustainable. It's going to absorb all the power of the world in by 2025. All this FUD and garbage around the energy use of Bitcoin. And I think that it really clouds the actual nature of what Bitcoin mining is. And so I'm really excited to dive further into this with you. There's something that we talked about when we were kind of just doing our pre-video was um, these two distinct natures in energy markets. Could you kind of
Sure.
break down what those are?
Sure, absolutely. I think the right way to understand U.S. power markets, I think this is probably true of other regions as well, but the U.S. is, my main area of expertise. There's sort of two types of power markets in the U.S. There are regulated power markets and there are deregulated power markets. And you can basically draw lines around the map of the country, highlighting what parts of the country have had their power markets deregulated. There's another
Quickly
dichotomy
before you dive.
Go ahead.
Oh, yeah. So I was going to say, just quickly, could you explain the difference between a regulated market and a deregulated market?
100%. So, power markets are made up of what can be a vertically integrated value chain, which starts at generation, the production of electrons, and goes through to transmission, the sending of those electrons from where they are produced around the region, and then ultimately the distribution of those electrons down to units of consumption, lower voltage units of consumption, which are usable at the household and commercial and industrial level, right? At voltages and volumes that power our cell phones, our computers, maybe even our ASICs, right? So power markets have this integrated chain of production, distribution, and consumption. Up until basically the 90s, okay, so relatively recently, energy markets in the US were regulated. They were centralized, and there were utility behemoths, conglomerates essentially, that controlled that whole value chain all around the country. I looked this up ahead of time. So I think it was in 1977, I've since learned, that the federal, that FERC, which should be the Federal Energy Regulatory Commission, anyway, FERC, the federal level body that's in charge of administering energy markets across the country. It was only in 1977 that that agency, which is huge, which is like the agency for energy in this country, was given form. Fast forward to the 90s, and with a growing economy, with growing needs for power, and only these old school centralized utility behemoths to do the work of like building new power plants and driving costs down to their lowest marginal cost basis. There was a movement to deregulate power markets and harness the power of private capital, private sector, incentives to compete and drive down costs, right? To increase efficiency, drive down costs. And so about half of the country in terms of like land, but well over half of the country in terms of load, in terms of like consumption, exists in deregulated power markets at this point. And what we mean by deregulated power markets, just to be clear, is in a regulated paradigm, you've got that whole vertical value chain that I mentioned, from generation to transmission down to distribution. In a regulated context, that's one company that controls the whole thing. It's a monopoly. All right. In deregulated markets, that is broken up, and you have competition at essentially every level of that value chain. Deregulated markets basically follow the coasts with a few additions. In the Northeast, New England, New York, and the Mid-Atlantic are all deregulated power markets. ISO New England, New York ISO, PJM. All right. Anywhere where you hear ISO, independent system operator, almost certainly you've got at least a partially deregulated power market. ERCOT, Texas, of course, is the classic deregulated power market. Over in California, you have a mostly deregulated power market in Cal ISO, CAISO. And in the middle of the country, you have some, hybridized regions. MISO, the Midwest Independent System Operator, is partially deregulated, but big parts of the Midwest are still regulated. And then everything else, the Rockies, Desert Southwest, the Southeast, SPP, which is the Southwest Power Pool. Those are all basically regulated power markets where, again, you've got typically one entity, one utility that controls the whole value chain from generation through to transmission through to distribution, right? So that's sort of the setup.
So basically, we're thinking Bitcoin, huge idea of decentralization. You can think of this as like regulation is a centralized market versus non-regulated markets are the decentralized markets. And so in the decentralized markets like PJM or ERCOT, you're going to find better pricing than you would in, say, like my origin, which is Oregon. I don't know the power provider that we have, like Portland Power or something like that. The power prices are basically fixed, whereas in a competitive market, it's a lot easier to find better pricing and choose between your power provider. Am I kind of on the right track there?
I would say yes, but taking a step back and trying to be as objective as possible, What you have in the deregulated context is flexibility and, I would argue, resilience. Okay.
Mm-hmm.
You have a bit more complexity, but I would really say it's diversity that exists in the deregulated context. In a regulated power market, again, there's one really big kid on the block, and that's it. And if the kid wants to play nice, if times are good and stuff is cheap, you're going to get a good deal from the one kid on the block, right?
Mm-hmm.
If times are not as good, and we've seen some of those times recently, and that's why this is really important. And again, I think as we sort of turn the page on, I don't know that we want to necessarily be political here, but we turn the page on the election, and frankly, we enter arguably the most supportive regime for crypto that, well, I don't know if that's ever existed. I mean, El Salvador, I guess, gives anybody a run for their money, but anyway, the most supportive regime that this country's ever had, right?
Yeah, for sure.
So what's important to bear in mind is we've had bad times in the energy market recently, and the new norm in a world of increasing climate volatility is that bad times can emerge, at least temporarily, kind of all the time. That's for better or for worse the new norm. All right. So what I mean by this is, the big thing that happened recently, this might be obvious, but just for the record, I think a lot of existing miners have probably felt this painfully, right?
Mm-hmm.
We've just exited, hopefully, the most inflationary environment that this economy at large has been in for decades, right? For half a century. And that showed up directly in energy markets, particularly in natural gas. One thing about the US power market is it is intimately related. It is highly correlated, and maybe even, there's some causal, more than correlation, into causation, right? There's a tight connection to natural gas markets. That is a fundamental fact, which really got hammered home by the boom in natural gas production that took place in kind of the mid to late 2010s and ongoing via fracking, frankly. Okay.
Mm-hmm.
During the COVID and post-COVID inflationary bubble, and then really unequivocally, just absolutely hammered home by Russia's invasion of Ukraine, right? Natural gas pricing blew through the roof. And the reason why the Russia thing is relevant is because Russia, until the war, had been the largest supplier of natural gas to Europe. And of course, once the adversarial sort of dynamic emerged, or otherwise became more of a hot conflict, Europe reoriented its energy supply chains, and frankly, we began exporting natural gas to Europe. Right. This drove up the cost of natural gas, and by extension, power, like we had basically never seen before. Certainly had never seen since the new conditions that have become a norm emerged over the 90s and the early 2000s, as I mentioned. And so when times are not good, when stuff is not cheap, when stuff is expensive, and you're stuck in the regulated confines of a vertically integrated utility, you don't really have any choice. You're a price taker. The utility is going to tell you what things cost. You might have had to deal with them prior to this, and this happened to a friend of mine in the Pacific Northwest. Had to deal with the local regulated utility at a very nice rate, and then all of a sudden inflation starts ticking up, and the deal that he thought he had suddenly started going up by not just percentages, by double-digit percentages. And next thing you know, it's borderline uneconomical. Right.
Okay.
So in the regulated power markets, that's all you're a price taker. The utility tells you what it's going to be, and there's not a whole lot that you can do to fight it. In regulated markets, you've got competition, you have diversity in who supplies you with energy and where the energy is produced from, so on and so forth, and you have all these different ways to markets are what they are. Prices are what they are at some point, right? But you have all these different ways to contain your costs, whether they are coming from curtailment incentives, demand response, and other, grid-related incentives, and we can talk more about that, of course. In the deregulated context, I mean, this is very apropos, sort of the Bitcoin mindset. You're in the free market, right? Nobody can tell you whether you need to operate under these conditions or not, right? If you're in a regulated power market and you have a PPA with the utility, if you don't consume at some point, your PPA is like you're in violation of your terms, right? In the deregulated context, assuming that you haven't locked yourself into some contractual obligation, you can power down based on price signals, right? In the deregulated context, go ahead.
No, so I was going to say this kind of transition into one of my questions is this why in Bitcoin mining specifically we see like a huge draw towards, Texas and places like Pennsylvania, Ohio, specifically for mining because of these deregulated markets?
Absolutely. So they're sort of regulated and deregulated markets in some ways are like the inverse of one another. In regulated markets, it's simple. You're dealing with one counterparty, and if times are good, you're going to be able to get a good deal, and hopefully it'll stay that way, and you can ride it out, right? In the deregulated context, you're dealing with a diversity of different counterparties, and frankly, the incentives might not lend themselves to locking in term contracts, right? The whole point of being in these other places is you have flexibility, right? So you might have a floating market index on your energy costs. The nice thing, though, is because you are in a free market environment, you can put a cap on your energy prices, right? Now we have all this technology, API interfacing with your servers and so forth. You can push a button. You can set a cap and say, look, anytime the floating power market is above 4 cents a kilowatt hour, 5 cents a kilowatt hour, whatever, your price threshold that you choose happens to be, I power down. And you can do that, right? So at a minimum, you have this ability to control your costs, to manually or digitally, on an automated basis, control your costs. And on top of that, again, because of the free market environment, the incentives around grid reliability and ancillary services, grid services, the utility or the ISO, the independent system operator, will pay you under the right conditions to power down, right? And those conditions often, it's not a coincidence. Those conditions often coincide with the highest rate hours, right? The highest priced hours. In a market, of course, demand goes up, price goes up, right? And so during the times of the day and the times of the year where you have the highest demand, right, you also have the highest threat of grid unreliability, right? That that demand might outpace supply, and you might face blackouts or rolling brownouts, right? Like happens in California these days, frankly. The grid will pay you to power down in the right regions, like in Pennsylvania, like in Ohio, like, to some extent, like in Texas. The grid will incentivize you, if you are flexible load, to power down during those price events. And again, coincidentally, not only those price events directly coincide with the highest cost hours. So you're sort of having it both ways. Not only are you going to reduce your costs by shaving out the highest cost hours, you're also probably going to be paid for that service because you are doing the grid a service. As flexible load, you are serving as a reliability resource.
So that's demand response specifically, correct?
That's right. That's right. And, in places like PJM, so, you mentioned Pennsylvania and Ohio, you have demand response takes several different forms, right? You have economic demand response, basically the price arbitrage that we kind of described, right? Like, I mean, I don't want to mine, or, it's not only for miners, it's for anybody. I don't want to have my air conditioner on when prices are above $50 a megawatt hour, 5 cents a kilowatt hour. Okay, so I'm going to power down, right? Economic demand response. On top of that, you have the grid reliability event-driven incentives that I described. There's a few different programs. You have what's called Emergency Load Response Program, ELRP. where during intense weather events, typically like natural disasters, right? Big freak snowstorms, crazy, heat waves, what have you. And the market over the course of time is at risk of demand outpacing supply. Boom, ELRP events take place, grid will pay you to power down on top of the savings for missing those high cost hours that I already mentioned. You have another shorter duration reliability related program from the grid and PJM called Sync Reserve. Okay, rather than like that sort of slow buildup or like longer time interval dynamic that takes place under ELRP, Sync Reserve is related to events that might have a response time of like 10 minutes, right? So you really need high tech flexible load. Like frankly, Bitcoin mining is perfectly situated to provide this sort of service. And that's going to come from things like a power plant, just like tripping, like going offline, the natural gas plant, had a burner go out unexpectedly. Boom, it's going to, turn off, and the grid is going to have this just disruption, right? And so sync reserve signals can be sent out, and again, you're going to get paid to respond to that. So yeah, you have all these different programs. There are also some like very local programs. There's a few in Pennsylvania specifically. I forget the numbers and the names, but a whole diversity of incentives that are out there.
Yeah. So we hear a lot. We don't hear a lot about these specific demand response programs, but you hear about demand response and curtailment. Are these the same things, or are they kind of like interchangeable or different?
Basically the same thing. Curtailment can mean, in my world, in power markets, curtailment can mean a bad thing, especially in regulated power markets, where it's like you're being curtailed. And sorry, that's just happening now because I'm the vertically integrated utility. And like on the gen side, a wind farm, you're spinning at the wrong hours and I don't want them. Boom, you're curtailed. Or on the load side, we got a scarcity event. Sorry, lights are going off, right? So curtailment can mean a bad thing at times, but that's semantic. Generally speaking, deliberate, intentional curtailment, typically it's happening because of incentives, and demand response is, the common term. That's sort of a catch-all for all the different programmatic angles that I described.
Okay. Awesome. That makes sense. So, we've seen Bitcoin miners explore renewable energy resources recently. So how do power markets enable miners to integrate renewables, and what advantages does this bring to Bitcoin miners?
Sure. I've thought about this a lot, frankly, because, and part of why I was very interested in doing this podcast is when you have an energy intensive sector like Bitcoin, and we're in this incredibly supportive environment, now politically, but also, coin pricing is up. Energy pricing has corrected from the highs that took place due to, global conflict and inflationary bubble, right? It's been high in my mind to find more ways to connect the value proposition of renewables and decarbonized energy sources, with the sector. The fact is, the marginal cost of producing your typical renewable megawatt hour, wind, solar, and so forth, is almost zero. So that's sort of a wonky economist's lingo, but the basic logic is all of the costs on renewables are around CapEx. They're around building the thing. And then you got to pay back financing, and sure, you got to make sure operations and maintenance costs are paid for, but there's no fuel. It's not like gas or coal or nuclear or whatever, there's no, the input is, if the wind is blowing or the sun is shining, that's your fuel, right? The marginal cost of producing electrons is really low for renewables. For better or for worse, though, of course, the wind doesn't always blow, the sun doesn't always shine. And for an industrial sector like Bitcoin, where on average you're looking to spend as much as possible, right? You're looking to keep the miners running, except where perhaps like we just talked about a minute ago, demand response or peak shaving, economic curtailment might tell you to power down temporarily, right? Generally speaking, you're looking to be up for the majority of hours any given day, week, month, year. And so, as a baseline fact, as from a first principles perspective, renewables are your best source of energy. I mean, it's cheap. The marginal cost of production is incredibly low. Shaping it so that you're meeting the relatively around the clock need of a mining business, there's some savvy required there, some market expertise. You're going to be better suited finding that in a deregulated market than you are in a vertically integrated, right? Like a regulated market, because you're going to have more tools in your toolkit.
Yeah, it seems like that becomes the big issue or the big challenge for miners looking for renewable energy resources in deregulated markets. Because like you said, the sun doesn't always shine and the wind doesn't always blow. And then there's even, you've got places like Texas and Arizona, which are great places for solar fields. But then again, Montana and Ohio might not be the best place for those solar fields. And so that's kind of what I was thinking when you were explaining that.
No, I mean, when you have the flexibility of the market on your side, you can do funky and effective things like financially hedge your energy costs, maybe with a renewable developer who is looking for a term contract in order to get financing, so on and so forth. And on the flip side, you can provide them with a fixed price that covers some of your hours, right? Or if you've got the right counterparty on the other side, maybe they can shape it, right? They're going to combine, some developers are developing both wind and solar. Some developers are developing wind, solar, and batteries, right? Dispatchable sort of additions to, their projects, right? With the right counterparty behind it, there's a lot of things you can do. You can shape on a financial basis and give yourself at least a virtual hedge, right? Like people will talk about virtual PPAs, which are basically just financial contracts, usually with new build renewable projects that effectuate a price hedge. And if you do it with the right counterparty, you should be able to shape something that meets your full profile, your full energy need. But yeah, I mean, for sure, it's that's a needle that needs threading. It won't do it on its own because of exactly the point you just mentioned. I mean, like the parts that of the project don't necessarily come together on their own without having some of those market-oriented tools to put it together. You see what I mean?
Yeah, no, I do. I guess, how do miners who, a lot of these guys were like, not myself, I'm not an industrial scale miner, but these guys are blue collar workers. I mean, they're boots on the ground, renegades, like analogous to the oil miners back in the day. I mean, and still happening today. How do these guys find, the resources to, for lack of a better term, thread that needle?
Sure. I mean, I have a little bit of a bias just given the nature of my work, but my bias is mostly based on knowledge, right? Like there's an immense amount of value, a wide diversity of resources that can be brought to bear when you've got the flexibility of the market on your side. So I would start by saying being in a deregulated market automatically is going to give you more tools in your toolkit. From there, you've got a little bit of, and I hate to punt, but you've got a little bit of like a case by case sort of situation to think about. if what you're worried about, if what you're thinking about is matching profitability with, decarbonization, right? Um, Demand response, almost by definition, lends itself to decarbonization, and it's because of, like I said earlier, right, that it's a funny coincidence that the highest incentives for you to curtail are going to happen at the highest demand hours, which, if you then think further through that logic, that's also going to be when the grid is at its most carbon intense, because demand is high. And so you're looking for supply from whoever can make it. That 1950s era oil peaker that most hours of the year just sits idle during high demand time periods, they're going to spin, they're going to, produce electricity, right? And so if you're curtailing during those hours, almost by definition, you're decarbonizing the grid. You see what I mean?
Yeah, no, I do.
There's also, and this is often, I've of course, a secondary concern. Economic viability is the first order priority. To the extent that you go beyond and you want to proactively decarbonize, and we've seen lots of miners, especially the big dogs out there, doing this sort of thing. You can buy credits, renewable energy credits. Actually, I often joke, in the company, that the original NFT, the original non-fungible token, was a renewable energy credit or a carbon credit. It's a digital asset that has a tracking number, and it represents an entirely unique event, production of carbon, or the making of a renewable megawatt hour, right? It's transferable online. It's retirable once. That's it, right? In any
Makes
case,
sense.
in the market context, you can buy these attributes to show, look, if I'm consuming grid electricity, I don't necessarily have a PPA with some wind farm or some solar plant, but I bought this renewable energy credit and I've matched it to every megawatt hour that I've consumed, right? I mean, everybody in this country that takes decarbonization seriously, from Google through to, your mom and pop liquor store in New Jersey, right? If they want to be active in these markets and they don't necessarily have the resources or the know-how to go through all the trouble to lock in a PPA with a power plant, they're doing it through renewable energy credits, and typically renewable energy credits.
Interesting. So this kind of goes back to power generation and where that power comes from. But I'm curious what your thoughts are on, like, the spinning up of small nuclear reactors and other more efficient power generation plants. How does that kind of play out in the next 5 to 10 years, and what would that look like for Bitcoin miners trying to get that cheap power? Isn't it kind of a two-way incentivization where Bitcoin miners are trying to incentivize the power companies to invest in that kind of power?
It's a great question, and now you're touching, your finger on the pulse of what's really hot and like live topics in power markets at large, in this country. So data centers and Bitcoin mines are like cousins, right? I mean, they have a lot of the same infrastructure, a lot of the same cost considerations, of course. And
Often called the same thing.
That's right.
Yeah.
The reason why it's big tech companies that have huge data center footprints, Microsoft, Amazon, and so forth, that are rekindling interest in nuclear power generation in this country, whether it be looking to restart huge, grid scale, old school nuclear power plants, 3 Mile Island, right? I've been doing this a long time, and like, I would not have guessed that the incentive set would lend itself towards these sorts of power plants coming back. It's amazing. But also through to new technology, small modular reactors and so forth. The reason why they are doing that is precisely because of the considerations that we just talked through. They need, and especially for data centers, which do not necessarily have the same flexible load capability that Bitcoin has, right? Miners can, there's some, there's some revenue loss perhaps in curtailing for a Bitcoin miner, but maybe not. If your demand response incentives are high enough, right? With data centers, typically it's a critical requirement to be on 24/7, and so they need around the clock power. And the tech companies, whether it's because they're investors, the stock markets at large are paying attention to their ESG filings, their environmental, social, and governance filings, or because they're, stakeholders, their, decision makers understand, climate change and want to reduce their carbon footprint. Think Bill Gates and Microsoft once again, right? Whatever the reasons, they need base load around the clock power, and they want it to be carbon free if they can have it. And it's really hard to get that seamlessly by cobbling together, say, wind and solar, and maybe with some batteries to smooth it out. You can do it that way for sure, but it's simpler and it's larger scale to do it via, a nuclear power plant. I don't know that I would necessarily, and actually, no, I should be more straightforward. I would not assume that nuclear power is cheaper than those other resources that are available out there. It's certainly not cheaper than standalone wind, standalone solar, or really standalone. I mean, classically, it's one of the most expensive forms of power because you have big capex costs up front, and then you have ongoing fuel inputs, right? And then you've got waste management on the back end, right? Like, what to do with the uranium and plutonium and so forth that's been spent, right? What do you do with that once it's done? It's not so nuclear power gen is not typically considered a cheap form of energy, but it's reliable, it's around the clock, and it's carbon free. And now with new technology developments like SMRs, as you mentioned, there's sort of hope, right? There's the expectation that some of the operations and maintenance considerations, like what to do with the spent fuel, are going to be better managed, that you can extract more energy from that fuel using new technology. And sure, with enough commercial proliferation, that's always what is required, right? Is the commercialization of the technology. You could hope that the marginal cost of building an SMR will go down, right? That CapEx consideration hopefully should go down. But we've got a ways to go, I would say. So over the next 5 years, I think you had originally asked, we're expecting to see more of that stuff. How many new SMRs are actually funded and come online? I don't know that it's clear it's going to be a wave. Everything is gradual and then sudden, right? It starts, the hardest ones are the first few, right? But there are more incentives now than ever before. You have state level renewable portfolio programs, like, the programs that have enabled wind and solar to get built with such success around the country, right? You now have carve-outs that are being allocated to SMRs, right? Like, it's not just Amazon and Microsoft. Utilities are taking this seriously. So there will be more and more nuclear utilization. There will be a revival of older power plants, or a renewal of older power plants that might otherwise have faced potential shuttering, given enough time, and fully expect there to be the build out of, new technology resources, SMRs, and so forth. Definitely the trend will manifest into commercial reality over the course of the next handful of years. How far it gets is a little bit hard to expand, to predict.
Yeah, I guess I was very uneducated on that whole thing, because I was under the impression that more nuclear power plants, small nuclear reactors and stuff like that would make the power generation a lot cheaper and the end user would pay less for power. But I guess it's more of a reliability thing and economically, or not an ecologically friendly scenario, not really a cost prohibit or cost savings.
I would say not upfront. I'm not an
Mhm.
SMR technology expert, but I think it's safe to say that the first projects will not necessarily be the cheapest ones. But as you
Okay.
commercialize, but the same was true of every new power generation technology in this country: solar, wind, you name it, batteries now, right? Um, they're never their cheapest form of production until you build enough of them and you build a whole value chain, a whole ecosystem around their implementation. That's what the free market does, is it drives down costs for desired goods to their lowest marginal requirement for production.
Okay, that makes sense. Yeah. So, I want to take it back to a little bit to
Sure.
like the whole Bitcoin miners side of things. So, like for Bitcoin miners looking to build out their operations and remain profitable, economically stable, these kinds of things, like what should they consider when looking at different locations? Let's say, they're like location agnostic and they're trying to build out a 5 to 10 megawatt mining facility. What are the kind of key considerations they should take into account when looking at specific markets?
Sure. Like I said, I to me, it makes sense from a resilience standpoint and from a flexibility standpoint to situate yourself in markets where you have built-in programs that incentivize flexible load and give you tools to contain your costs based on market conditions, right? At the moment, I think there's an allure around regulated utility footprints because at the moment we've left the inflationary bubble we were just in, and you can probably cut what looks like a pretty good deal. Over the course of time, you might find that that deal wasn't as good as you thought. And unfortunately, should that occur in a regulated market, you don't really have much choice what happens then, right?
Hmm.
In the deregulated context, you've got a lot of choice. You've got a lot of tools in your toolkit for solutions. I would think that if I think through to like, my friends in the industry, they would probably point to, you know, um, ecological conditions, and really what I'm getting at is weather, temperature, right?
Hmm.
Texas is, arguably the most market-oriented power market in the country. I mean, it's pretty safe to say that it is. But it's hot. It's really hot,
Yeah.
right?
Yeah.
And the thing about Texas, and it's not even just Texas. The thing about um, the the state of the world at this point is volatile weather events have become the new norm. And we just had I'm going to blank on, was it Helene, or what was the one that
Hmm.
devastated North
It was
Carolina,
Helene.
right? Yeah.
Yeah.
So I mean, unfortunately, this is the new norm. 100-year weather events happen every 2 years, right? It happened in ERCOT, and it didn't happen in the summer. You had Winter Storm Uri
Hmm.
in winter of 2021, which blew the market out. Prices went through the roof because no one was expecting it. But that's the thing about this stuff, is like if you cannot, the best way to hedge against unpredictability is with flexibility, right? And that's really
Hmm.
what I mean about resilience. The resilience of market oriented footprints is like you've just got more tools in your toolkit. So I like I said, I might have biases. I probably do, but I like the deregulated markets, and I like PJM. I like Pennsylvania. I like Ohio. Um, you have some cost elements built into those markets which might not exist in Texas. You have renewable portfolio standards, renewable incentive programs in Pennsylvania, for example. But frankly, that also means that that earlier in our conversation, right? If you care about decarbonization, if you care about what you can tell your investors or your stakeholders about the nature of your operation, built into your power bill in Pennsylvania, there's going to be a line item for a renewable adder, right? Even if you don't go out and buy your own. And even if you're not pointing to demand response as inherently being a decarbonization contributor, right? You literally have a utility line item, right, in your utility bill. So I like those regions. I think there's opportunity all over the country at this point, but those are the ones that stand out in my mind.
For sure. Yeah, it sounds like I've definitely heard that there are problems in Texas. Like you said, it's very hot, which means that if you're going to be a viable mining operation, you're going to have to invest in something like hydro or immersion, which is going to keep your temperatures down. But I mean, the infrastructure costs for those kinds of mining operations can, be upwards of $1.5 million per megawatt. So if you're looking to be an air-cooled miner, which is significantly cheaper, you need to be operating in these lower temp climates. And so Ohio and Pennsylvania specifically would be a better region, especially with the deregulated power markets in that aspect. Like Oregon would be a good place, but you have this regulated market, which is difficult in times of stress. So that makes a lot of sense, and I thank you for clearing it up. So we're
Of
gonna
course.
kind of close out here in the next 10 minutes. I want to kind of ask you a few philosophical questions about your personal opinions based around Bitcoin and Bitcoin mining. So the first one is, in what ways do you see power markets evolving to support industries like mining in the future?
I mentioned it already, and I think I'm not sure whether the mining community thinks of itself this way, but to me, when I look at Bitcoin, it's in some ways it's a derivative of energy, right? It is the embodiment of energy and scarcity. And so, to the extent that mining and like the sector at large continues to proliferate, power markets and mining, but data centers, right? Like the whole that whole ecosystem will have to, if not merge, there will be greater and greater integration between them, right? Responsiveness to the needs of the sector per the, that's what markets do. They come up with solutions. So to me, they're like intimately related. Um, I'm not sure if that exactly answers your question, and I don't want to,
It
not to get overly wonky, but yeah, to me, they're like other, two sides of the same coin.
Yeah, they just go hand in hand. So,
Say,
the next question I have, this is the last and final question, and I ask everyone on the show. It's one of my favorite questions to ask. So, Jonathan, what does Bitcoin mean to you?
sure. I'll be honest. Like when in the late 20 teens, when Bitcoin really hit the mainstream stage, I was skeptical. I think a lot of people were, right? And especially because even at that time, it struck me that this is a really energy intensive sector. How could it possibly withstand like the cost profile, so on and so forth? And what's become by now, just by way of scale and dollars at stake, it ain't going away, right?
Yeah,
This thing is here to stay. Um, I think, and so now taking that essentially as granted, um, as a store of value, I know that this has been a debate over the years as to like, what is Bitcoin? Is it more like gold or is it more like the US dollar, right? I mean, to me, it looks a little bit more like gold, whatever the case without, using trigger terms, as a store of value, I think it's fascinating that this is the first unit of value that is native to the internet. I think a lot of, enthusiasts see that as being something novel and important about Bitcoin as like the first major, truly natively digital value marker. that's striking to me. That definitely resonates. I've said it 3 times now, but given my background, hopefully, people understand why it's so compelling to me. As a unit of value, to literally embody energy and scarcity, that strikes a chord for me. And the last thing I'll say, which you touched on, and I know it's embedded in the culture. I don't know that this is not necessarily again, I come from energy per se, where there's been a wave of decentralization incentives that have occurred over decades, right? And, the 90s was really when deregulation began, and we're still going through it, right? Solar, not just solar, now batteries and so forth, but like, it's the ultimate distributed energy resource down to the unit of your roof, right? And down to the level of the power pack in your garage that you can now use to directly fuel your electric vehicle, right? And like we talked about, things like demand response, all of these new phenomena in energy markets are part of a decentralization wave that inherently lends itself to resilience. And if we want to get like not quite political, I think this is bipartisan, but like energy security, right? And yes, decarbonization, right? It all lends itself to to that end goal. I think that there is something interesting about the way in which Bitcoin represents decentralization unto itself. I think that that's that part of the culture to me looks like there's some ebb and flow. But I mean, this is the first new value unit to show up in the world, since I don't know, the dollar. Anywho, I think to me that's interesting. I don't know how far I would take it because I haven't thought about it enough, but I do know that decentralization is an ongoing thread in my world, and it seems to be one that also lends itself really well to mining.
100%. It's decentralization. I think Satoshi, I'm not even going to try to quote Satoshi, but we got to decentralize the world, and that includes energy markets, that includes Bitcoin mining operations, everything from the computer up to the actual like industry. It matters. So decentralization is playing a huge role in that. So I'm excited to see where the market goes, where Bitcoin goes, and what happens with the overall industry as a whole in the next 5 to 10 years. I'm pretty bullish. I'm not going to lie.
I hear you. I understand. And I mean, for what it's worth, especially given where we are at this moment, it's pretty tough not to agree. I mean, again, it couldn't be more obvious that the stuff. I mean, to say that it's not going away is like is asinine at this point. We've got now the most supportive, government in this country, for crypto that we've ever had, and market cap is, we're hitting all-time highs every other day. So
1.6 trillion is what I checked today. I mean, we hit $80,000 this morning. So I mean, the sentiment is definitely very bullish. I walk around, I see Twitter posts. Everybody has this air of like positivity about what's happening, and it'll be interesting to see what happens in the next 4 years. So
I mean, I'll tell you right now, a big part of why I wanted to have this conversation, and thank you for having me, and I'll send my thanks through to Scott, is I mean, it's important to get it right. With so much opportunity now, I think it is the moment to thread the needle that we talked about earlier, right? And the nice thing about it is, in my world, and not just my world, I think in the world at large, the best thing is when you have these win-win situations, right? These double, triple bottom line situations. And mining can have that too. Frankly, it should have that. You can contain your costs while decarbonizing. And really all you're doing is what you should have done anyway, because you're shaving, those most expensive hours, in your day, your week, your month, your year. So anyways.
Makes sense, man. Well, hey, I appreciate you coming on today. It was very insightful learning about energy markets. As a home miner, I didn't really understand a lot of this beforehand, and now I kind of understand the dynamics at play. So I'm hoping that our audience also found it very interesting, fascinating, educational. Where can people find you or reach out to you if you're willing for that to happen, if they want to find out more about how energy markets play into building out operations?
I'm pretty out there. Karbone is, I mean, we're humbly, gratefully, an industry leading platform. And I'm on all the apps. I even have a Telegram account. That's new, but I even have a Telegram account. So yeah, I mean, you all have my info, and obviously I leave it in your good hands on how to filter. But I'm pretty approachable, and again, power is the world that I come from, and I think there's a lot to do. So yeah,
Okay.
for sure, can hit me up on pretty much any of those media.
Okay, yeah, I'll put those in the description of the video so people can reach out if they want to. Again, thank you so much for coming on. This was super insightful. Maybe we'll have you come on again and just kind of explain, the changing market landscape as we see more of this Trump landscape shaping out in the future.
Where I mean, this is kind of a whole new world that we're in circa last week, and
Yeah.
the markets at large, the industry at large, and I mean power, but of course I think for crypto, everybody's trying to figure it out. So yeah, absolutely, would be very happy to continue chatting about it.
Awesome. Well, thank you so much, guys. This has been another episode of the Build a Mind podcast. If you enjoyed this episode, please comment, leave a comment, subscribe, share it out with your buddies, let them know. And if you're an industrial scale miner, this is the kind of content we're trying to share out as much as possible so that you are informed when you're building out. So I thank you guys for listening. I thank you guys for being a part of the Build a Mine ecosystem. I thank you, JB, and thank you, Bitcoin Mining World, for allowing this to happen. We will see you guys next time on the Build a Mine podcast.
Please note, the Build a Mind podcast provides information for general educational purposes only. This information should not be construed as legal, financial, or investment advice. We do not guarantee the accuracy or completeness of any information presented, and we encourage you to consult with a professional advisor, legal advisor, and/or financial advisor before making any financial decisions. The Build a Mind podcast and its affiliates are not responsible for any losses incurred as a result of using the information provided.